if inflation does remain well below target in and around the 0% mark, then then there's always going to be this kind of background wondering if and when they're going to do more, and the market's going to start pushing for them to increase stimulus at some point in time if that inflation remains low. There's a good chance that it won't, because we're getting to the point now where we're almost a year past the big fall in the oil price. Obviously, oil still at those low levels, but that sort of yearly change, which we use to judge inflation year over year, that oil price change is going to start coming out of the market around kind of March time. So we actually could see the year-over-year numbers start to reflect a more of a kind of leveling out and then starting to rise in sort of just the non-core benchmark inflation rate. So then that would suggest that actually the ECB isn't going to do any more or don't need to do more. So that's got implications for the euro. There's still a big divergence between the euro and the US, and even the euro and the UK. Worth putting up the euro-pound chart because we saw a big push higher there, potentially a inverse head and shoulders pattern setting up here. It's not perfect. The patterns never are. The head is only slightly deeper than the left and right shoulder. From that perspective, you could almost call it a triple bottom, but potentially a big basing pattern here. And so then we'd look for the neckline. The most extreme one would probably just be up at those peaks here around 75. So having failed to drop through the 70 round number on 3 major occasions, if we were to push above 75, that could suggest that we're pushing all the way back up to 80. But obviously, there's still big policy divergence between the UK and the Eurozone. We're still looking to raise rates in the UK. We've got the Bank of England later this week. They are expected to keep rates on hold, and if they're going to continue the language from the inflation hearings, then it's going to be fairly dovish, and that could push expectations for a rate rise in the UK out to 2017. And so then, given a slight kind of change in circumstance, slightly less easing than expected from the ECB, even more dovish than expected from the Bank of England, could see this rate pushed back up to the 75 level again, because that size of the difference between the two countries the extent of the divergence has come in a bit if the two central banks ease away from the extremes that we thought. Obviously, the other impact from the ECB last week was on equities, prime example being the Germany 30. You can see this take place in other markets. Well, this weekly chart's looking a bit crowded, but just sort of going to show that we're still, it's difficult to see. Basically, we took out this high here, which is where we still got this potential double bottom pattern in. But we haven't really cleared out a next peak yet. Potentially, this might be a peak that we can use to say that we've formed a higher high. Haven't really, here we formed a higher low. So kind of still while above the week of the November 15th low, still kind of technically within an uptrend. So if we can hold above there, might be all right in the Germany 30, but that is a pretty large bearish engulfing candlestick on this weekly chart. Looks even more extreme on the daily chart. And so a really aggressive sell-off has failed to take place because this previous low has not acted as, was support broke, didn't turn into resistance, we pushed through it. So the next level I'll be eyeing is, well, to some extent the 200-day moving average. It's not so reliable, but also just this peak from over here on November 20th. Some potential areas of resistance to see this trend roll over. But as I mentioned in the chart forum here, what we're seeing is that we've made a higher high and then we've made a lower low. So that's basically telling us no trend. So what I wouldn't be surprised to see is us actually push up towards the top near this high somewhere, maybe even push through it and then roll over, or maybe just not quite get to it and roll over and just turn into more of a sideways market again. Kind of reminiscent of the kind of thing taking place here. Bit sideways perhaps until a few days before or after the Fed meeting, which of course takes place in just over a week on the 15th and 16th of December. The other thing to look at is similar to what we did with the euro, and just zoom in on the lower time frames to find some potential levels. Here, this is that previous high that I'd used. This is actually the kind of low of the day on the 2nd, so the Wednesday, I believe. That would also potentially be some area. You can obviously also pull up some Fibonacci levels to see if they correspond. But as I mentioned, these would be areas to look for some sort of reversal for a continuation of the trend lower. But I don't actually think that that's going to happen right now. I don't think we're going to see some massive sell-off off the back of that decline in the Germany 30. I suppose what I'm basing a lot of that off is just the fact that we've pushed through this previous low, and that even the very next day, we couldn't push any lower. So if we're just sticking with equities for now, let's have a look at the UK 100. Here I pulled up a short-term chart again as well. Again, looking for potential areas where this rapid downtrend that we saw on Thursday could begin to roll over again. So, rapid downtrend retracement. We've fallen off a bit away from this 38.2% Fibo level. Kind of corresponds a bit with this low over here, and this hot peak over there. More about the fib level. Then we're moving back up into the 50, which I think we probably could get towards. And then we've got a couple of days where we saw quite sharp reversals that could see some kind of a slight vacuum in volume in around those levels, and see prices drop off again. So similar kind of idea where we've had that extreme move down. We're looking for cheaper areas to sell into it on signs of reversal. But again, we've basically made a higher high. Now we've made a lower low. So it's basically speaking to us of no trend, and also just the fact that it was these series of peaks up here that caused us to roll over in the first place. Kind of tells us that we're not going anywhere higher, and we've kind of paused at this low here. I suspect we could maybe get down to the 6,067 level again. So that would be, if you were selling from one of these retracement levels, then your first target would just be the December 3rd low. But if you were feeling more bearish, then you would start targeting the 6,100 level, just to sort of show that the market's in complete chop up and down here basically between 6,100 and 6,500. Okay. Over to US markets. You're probably going to notice a bit of a theme here. US markets are notably stronger than that in Europe. Obviously, it's slightly, more indirect beneficiaries of kind of risk-on mode in markets that quantitative easing brings about. So you can see here that this was Thursday's leg lower, not as extreme as we saw in the Germany 30 or even the UK 100. And on Friday, we had those non-farm payrolls results. It was a pretty good number, basically in line with expectations, slightly weaker than was seen in October, but November's data was nonetheless in line with expectation. Over 200,000 jobs created, some signs of wage growth still, unemployment rate stayed at 5%. So basically, the overall message was that not enough to derail the Fed hiking rates. So an FYI, in terms of the Fed, we've got retail sales on Friday, and then we've got inflation data next week. They're basically the last two hurdles for the Fed to have to jump over, for the data to jump over, for the Fed to decide on hiking rates. At the moment, looking at Fed funds futures, you hear this thrown around, the percentage. It doesn't always necessarily mean a lot, but there's basically an 80% bet that the Fed's going to hike, according to Fed funds futures at the moment in December. So looking pretty odds on. But, you know, should markets collapse? We've got Chinese data this week. That was the previous cause of the big August collapse. In fact, the very data that caused the collapse we have reported tomorrow. That's the Chinese trade data. So watch out for that. That comes out early morning tomorrow. So that, you know, that may impact the open of European markets tomorrow. That could be a big one. We also have Chinese inflation data on Wednesday. That's probably not going to show anything too cataclysmic. And then we have retail sales and industrial production data on Saturday, which could set us up, interestingly, for Monday next week, which is obviously the week of the Fed meeting. But the moment I've been talking about this in the chart form for a while is toying with a double top here, but just sort of based on a sort of 200-day moving average and the sort of general trend, assuming that it's going to be more of a consolidation topside breakout. But there's obviously significant resistance to the topside. You know, this peak from back in July, but then the all-time highs from you know, from earlier in the year, May and Feb. Is it May? Yeah. You'll notice definitely a bit of bearish divergence taking place here. The bearish divergence can turn to a bit of a potential setup if you just get a break through that declining trend line there on the RSI. That kind of nullifies the divergence for me, and could see us push nicely higher. Coming into the last 10 minutes of the webinar here, we've covered a few currencies while just talking about the ECB. We've covered some of the major indices. Happy to talk about others if need be, but if not, I'm going to switch over to crude commodities. Now, this was the other interesting move. This was not on the ECB. This was on the jobs day. This was on Friday. So, as in the 4th of December is when we saw this massive push higher in gold, which is interesting because the data was pretty solid, indicates that, as I mentioned, basically confirms the idea the Fed set to a hike in December. Typically, the reason, the assumed reason for the sell-off in gold is that you don't want to be holding, a non-interest bearing asset when interest rates are rising. You know, you want to kind of be there to take advantage of those rising interest rates and have your money in bank accounts or whatever the case may be. So, but, you know, on that strong U.S. data, gold actually rallied and rallied pretty massively, broke this declining trend line. So, obviously, this has been a pretty huge sell-off, and it's just slow. The momentum's just slowed heading into this long-term trend line here. And we've got a bullish engulfing candlestick in and around the bottom of this line. You know, and I think, obviously this kind of trend is generally down. I think probably the better possibilities are, more like along the top